Hi, and welcome back to another episode of the Real Return Show. Today, we're joined by Professor Aswath Damodaran, widely recognized as one of the world's leading experts on corporate finance and valuation. Professor Damodaran is a longtime professor at the Stern School of Business at NYU, and he has spent decades shaping the way investors, analysts, and business leaders think about markets, risk, and, of course, valuation. Professor Damodaran is the author of several influential books on valuation and corporate finance and is a prolific researcher in his own right. And perhaps most importantly, he's been a mentor to generations of students who now shape the global financial markets. Thank you so much, Professor Damodaran, for joining us
You're
today.
welcome. I don't think of myself as a shaper. I'm more of a disruptor.
Okay,
Good. I like that intro.
okay. Disruptor then. So I think we'll get right into it with our first
Yeah.
question. So your path is taking you from Chennai to now the classrooms of NYU Stern, where you've become one of the most recognized voices in corporate finance and valuation, being the dean of valuation. So we're kind of interested almost like in the origin story. So what first drew you towards this field, and maybe what experiences drew you to value investing specifically over more technical or, I don't know, algorithmic strategies?
I'm not particularly drawn to value investing. I think much of value investing as it exists today is moribund. It reflects the 20th century. Much of the thinking is for a market that's no longer here. It's almost nostalgic in terms of what it's trying to do. So I'm not a value investor, and my interest in valuation is really pragmatic. Much of where I am today is a result not of some revolutionary choice I made 40 years ago, but incremental choices. It's something that I try to pass on to my kids who want to make change quickly. They want to do big things and they want to do it right away. And I think real change often comes from chipping away, you know. So the most revolutionary choice I made in my life was to be a teacher. That was a choice I made a little bit more than 40 years ago in a classroom at UCLA where I was a teaching assistant for a class. It was an accounting class. I don't even like accounting, but I needed the money, so I was a TA. And I remember 15 minutes into that class thinking, this is what I want to do with the rest of my life. And I was just lucky. I think we all get what I call God shots, where you get this moment where you realize you're doing something you've always wanted to do. But most of the time, we're too busy to notice. We have things to do, places to go, to do items on our to-do list. I happen to be, receptive to that moment, and I said, "This is what I'm going to do." And I was going to go on the regular investment banking route, which was just starting to take off in 1981. And I went up to the finance department at UCLA, and I said, "Look, I want to be a teacher." And they said, to teach at a university, you need a PhD. And I said, do I have to get a PhD? And they said, yes. Otherwise, you're going to be an adjunct or a visitor. You're going to get abused and moved around and teach 15 classes. So I went for a PhD, not because I was interested in research. I've never been interested in academic research. And that's something an academic is never supposed to admit to. I wanted to be a teacher, and this was my pathway to being a teacher, was to get a PhD. And I've always described myself not as a professor, not as an academic, not as a researcher, but as a teacher. Everything I've done in my life is in service of that passion of wanting to teach, and it's a completely selfish impulse. There's nothing altruistic about it. It's what makes me happy. And having a bigger audience, a teacher is a repressed actor often, and the bigger the audience, the better. And all through my life, I've tried to expand my audience for my teaching. And everything I've written, every book, every class is essentially in pursuit of that mission.
Mhm. I think that segues pretty well into our next question, Lake.
Yeah, so the next question is kind of on like the way you teach and what you try to like teach into these students in terms of not only like technical knowledge regarding markets, technology, and the economy on a broader scale, but also like softer elements as well that you try to implement and teach to these students.
The technical knowledge is becoming so diluted, it's pointless. ChatGPT can do it for you. So if you're teaching content and that's all you do, hey, you really don't need a person there. I've never been big on institutional detail or technical knowledge. I've trusted my students to go out and get that. If they want to know what the listing requirement for the New York Stock Exchange, they don't need me in front of a classroom. 40 years ago, and definitely not now, to go through that list. There are aspects of valuation that you can call technical, how we define cash flows, and that often is not so much technical as understanding the language of business, which is accounting, understanding how accounting reads the world and sometimes misreads the world, and you got to correct for it. So there's some technical components to my class, but much of my class is about giving students a window into how I think through the answer to a question. I'm not interested in giving people the answer to the question, partly because I often don't know the answer. I have an answer. The answer is going to change and the questions are going to change. But if they can see the process by which I reason through to an answer, they can then develop that process for themselves. I mean, remember the old saying that it's better to give somebody a fishing pole than to give them fish. My job in teaching is to give somebody the fishing pole, the process of thinking through answers to questions. And that is, for many teachers, it's a challenge because when you lead people through the process of thinking through, it's like taking you into the kitchen of an expensive restaurant, right? Where you see how the food is cooked and all of a sudden the mystique is gone. You thought amazing things happened there, but people are dropping food, plates are being smashed, the chef is out of control. But that's what teaching requires, is to be okay with people seeing the places where you're uncomfortable, the things you don't know, the doubts you have. And I've never had a problem with doing that. And to me, teaching is about letting people see you work through a process, get stuck. To me, that's critical, that they understand that everybody gets stuck and that we all need coping mechanisms when we get stuck to work a way around it. So I live in the moment. I teach by letting people see the process. And because I teach valuation, which is about real companies in real time, I don't have the luxury of hiding behind abstractions or history or theory. When somebody asks me, what do you think about NVIDIA? I can't dance around it. I have to tell them this is what I think about NVIDIA. This is where I think its value is. And this is what I would do. And I'm very specific about it. I value companies for an audience of one, myself.
Mhm.
My actions are driven by my valuation. It's not my job to tell you what to buy. In fact, if you let that be my job, you're not doing your job. Every investor needs to take ownership. But here's what I'll do for you. I'll give you my story, and every valuation, if you're familiar with my work, I think is driven by a story, my valuation, my action. And then I'm going to hand the architecture of what I did to you and say, hey, you know what? Make it yours. So rather than sit there and bitch and moan about, hey, I don't like your story about NVIDIA. I think your market is wrong. I think your growth rates are wrong. Hey, here's the architecture. Change what you think I've got wrong. Come up with your own value. Let it guide your decision. I want the students in my class to leave my class with the power to make their own decisions. And when I think about students in my class, I include people who take my class unofficially. I teach my class in an amphitheater at NYU, 300 undergraduates, 350 undergraduates, 300 MBAs. But every year that I teach the class, because I put everything online, everything, the material, the lectures, the exams, I think about 50,000 people take the class unofficially. I think of them as my students as well. I want them to get that power to make their own decisions because if I can do that, then I think I've pulled off what my job was as a teacher.
Yeah. I think we've definitely, with these questions, established your role and I guess your passion for teaching, although you admit that it's not altruistic. But now I guess we kind of get into what you've said and what you believe when it comes to valuation. In the lectures that like I've heard from you and the talks that you've given, you often say that valuing a company is just as much about whatever the data and the number crunching as much as it's about the narrative and the storytelling. And especially today, as we see, there's many economic signals, lots of people saying this is right, almost too much data available. I think that the narrative aspect becomes even more important. So how can investors craft narratives that are both, grounded and disciplined, but also, flexible and adaptable enough to guide like reasonable investment decisions?
First, remember, you're not a creative storyteller, right? You don't have, you're not J.K. Rowling. You can't invent three-headed dogs and 16 new characters. You're telling a story about a business. So it's bounded storytelling, as opposed to what you hear in Silicon Valley, which is fairy tales. Basically, I want a high price. I'm going to tell you a story of $1 trillion market.
Mm,
So valuation is bounded storytelling. And to tell a bounded storytelling about a business, you need to understand how a business works. I
mm,
mean, one of the pieces of advice I give people is go hang out in a small business. Maybe your parent has a small business, a friend has a small business, a store they run, and see what they have to do as a business. I mean, how they have to maintain inventory, how they have to try to deal with customer needs. Because that is at the heart of every business. You scale it up and you make it $1 trillion business, you face the same challenges. You cannot value companies without understanding the basics of business. And it's amazing to me how many equity research analysts there are out there who know how to do financial statement analysis and project out numbers on a spreadsheet, but really don't understand what makes a business stay. So that's the first thing. The second is once you understand a business, you start telling stories, you got to recognize you're constrained by the laws of economics. What are the laws of economics? You have a great product, that's amazing. So you're on Shark Tank, you told me about a great product. What's the first question you're asked? Is how do you protect yourself from other people coming after you with replicas or imitations of your product? So when you think about a business and you think about this is what my company will do, you have to think about the rest of the world not standing still. This is like game theory on steroids, right? Everybody's looking at what you're looking at. They're trying to do what you're doing. And it's unrealistic to actually tell a story where the only one smart enough to understand what's happening and creating a narrative and creating value. You got to think about what others will do and build that into your story. And the third is, and this is advice that I think it's, when you first start doing valuation, I would strongly offer you is, valuation is like cooking. You learn by doing. The first time you value a company, don't expect your narrative to come right out of you. It'll be like pulling teeth. It'll be like the first time you cook. Fire alarms go off. You're probably going to order food from outside that day. But I think that what you have to do is start small. Pick a business. Don't go with, don't do Amazon as your first company. Pick a company that's compact, maybe DoorDash, some company that you understand that whose products you use. In fact, it's better to go with a B2C company as your first company because a B2C company is a company where you are the consumer. You bought their products. It's easier to value Uber than it is to value Palantir.
mm,
So pick a company where you understand what it does and then start digging into the numbers, digging into what drives the business. How does it make money? That's a fundamental question. And with Uber, the answer is easy, right? It makes money by being an intermediary, by connecting customers to car drivers and taking 20% of the fare. It's a simple business. So start with a simple business, build a story around it. Try to see if you can convert the story into valuation. Don't expect miracles. You're not going to be happy with the story. You're not going to have faith in your own valuation. That's a strange word to use, but remember the whole point of valuation is you need to be able to act on it. And I can almost guarantee you that the first time you value a company, unless you got an ego the size of an elephant, you
mm,
shouldn't be willing to act on it because you're still learning. So do it one step at a time. Take incremental steps, and you'll be okay in the long term. Things will get better. As I said, every one of us has two sides. We've got that storytelling side and the left brain, right brain. I know that's urban myth, but there's a left brain and a right brain, and you have a stronger side. My advice is work on your weaker side.
Mhm.
So if you're great with numbers, work on your storytelling. If you're great with stories, work on your number crunching because you need both in sync for you to be able to value companies.
Thank you.
Yeah, thank you. So this next question kind of like dives even deeper into like what advice you kind of have for people starting out in investing. Like, in your opinion, what do you think are the most common mistakes that analysts and people who are just starting out with value investing are making in the current investing landscape? You know?
If you don't have money, don't even start, right? I mean, to begin with in investing, you need money. So the question you got to give me is, what are you investing? Are you investing your college money? In which case, my advice is don't do it. You need it
Yeah, or
next
even
year or
like
2 years from now. So the first thing is you're investing when you think about what you need to do is going to be constrained by first what you're investing, what your cash needs are. This isn't an abstraction, right? You can't sit there be Warren Buffett if you have $25,000 to invest. And you might need that $25,000 in the next year. Be real about what you can do. If you're constrained to be short term, don't tell yourself that's wrong. I should be long term. You cannot be long term if you have liquidity needs. So start first with what you have as your investment money. And second, remember, investing is about preserving and growing your wealth. It's not about getting rich. That to me is what gets starting investors into trouble is they shoot for the moon. In which case, you might as well go to a casino, put all of it in number 25 and hope it pays off, right? Investing is not gambling. Investing is not about getting rich, it's about preserving and growing wealth, which creates some bad news, right? You say, how do I get rich? Go find a job which pays you well. Save 30% of what you make every month. Because to get rich, you need to start to build that wealth. You can't get rich by taking a small amount of money, putting it in Bitcoin, or you can, but it's not a sustainable, steady state, right? You might get rich really quickly and poor really quickly. I think we need to understand what investing is designed to do and what it's not designed to do. And unfortunately, for a lot of young starting investors who listen to YouTube, and there are two things in life that that I think get in the way of investing. One is what I call ROMO, and the second is what I call FOMO. ROMO is regret over missing out. On what? You look back and say, I wish I'd bought NVIDIA in 2018. I wish I'd bought Bitcoin 2 years ago. I wish I'd done that. I wish I'd done this. I wish I'd bought Palantir in 2011, 21. Because once you have ROMO, regret over missing out, two things follow. One is jealousy, because there are other people who did buy Palantir 3 years ago. And the second is you become an easy victim for conspiracy theorists who say, look, those guys got rich because they have an inside track. So if you want to get rich, you need an inside track. And guess what? I have the inside track. This is the YouTube guide. Just send me your money and I will do it for you. That's Romo. FOMO is the fear that you'll miss out over the next big thing. You know what's driving a lot of money into AI, right?
Yeah.
It's not that anybody other than the AI architecture companies are making money. Right now, the architecture companies are making money. The chip companies, the data centers, the power companies. There isn't a single company, perhaps with the exception maybe of Palantir, that actually makes money on AI products and services. Microsoft doesn't. A lot of free stuff out there. Okay? But everybody's piling into AI. You know why? Because they're afraid that this is going to be the next dot-com boom and they're not going to be there. To which my advice is, if you piled into the dot-com boom in 95 and 96, you know what you were buying, right? You're buying AOL, you're buying Cisco. You know what you weren't buying. The eventual big winner from dot-com was not any of the architecture companies or the companies that initially succeeded. It was Amazon, which came later in the game. There will be AI winners, but chasing after those winners right now might be the most dangerous thing you can do to your portfolio.
Yeah, and I think maybe for our final question, I listened to like one of your interviews on like CNBC on the news. Whoever the moderator or host was on the segment was talking about the tariffs and how those would affect the valuation. So this question's kind of in a similar vein to that. Right now, the interest rates are the highest that they've been in decades. So many people, obviously, the cost of capital then is going to change with the raising interest rates. But should investors be rethinking the way that they calculate the cost of capital in this higher interest rate environment? And
Obviously, right? Your money as an obvious place to go right now. I could put into treasuries and make 5% if I'm investing in stock. I mean, we act like the cost of capital is a magical, it's an opportunity cost. If I can make 5% over the next 6 months investing in T-bills or over the next 10 years investing in treasuries, and you ask me to invest in stocks, forget about, the Palantir or Nvidia, an index fund, I'm
Mhm.
going to demand more than 5%. That's what a cost of capital is. It's the risk-free rate plus a risk premium. And obviously, if risk-free rates are higher, I need to demand more of stocks. No? But to the degree that risk-free rates are higher, because inflation is high, I also get a tailwind with stocks. That same inflation is going to blow up the growth rates of these companies. So by itself, higher interest rates are neither good nor bad for stocks. It depends on why they went up and how they play out, not just in the cost of capital, but also in cash flows and growth rates. That's why it's not, if you ask me if interest rates go up, will stock prices go down? The answer is not easy. For some people, it might seem obvious. For me, it's never been obvious. So I think, when you think about value, you got to think about all the pieces. It's not just the risk and the discount rate, it's cash flows, it's growth rates. The entire system is tied together, and you can't just change one input and leave everything else unchanged. And that's what makes it tricky. And thank God it's tricky, because if it's not, then why do we need people?
Mhm. Yeah. Yeah, I think that was it for our questions for today. Thank you. Thank you so much, Professor
You're,
Damodaran. Yes.
you're welcome. Good luck to you guys.
Yeah, thank you.